Getting started. Hello there. I'm Mitch Goldberg. You're watching Be the Boss of Your Money. I'd like to get started a little bit earlier, but it's more important to put together a good show with useful information and perspective than to just say 4:30 we roll no matter what. Although I do want to focus on that. But it's a busy time and it's a pleasure to speak with you. Some of you who watch the show, I get to speak with you offline because you call me. My office number is 631 920 6622, and it's always a pleasure to hear from you. If you have any questions while you're watching the show, please ask in the comments. I do like to get your questions in the comments. Even if you want to call me with a question, ask me the question in the comments if you don't mind. It gives us I think it makes the show better because if you have a question, it means other people have the same question. And, words of wisdom, words of encouragement are always cool in the comments as well. And while you're watching, if you don't mind giving us a thumbs up, a heart, an applause, a celebration, whatever the reaction is available to you on whatever platform you're watching. People watch us on Facebook, LinkedIn, Twitter, and YouTube. And I post the highlights of the show usually a day or two later. So you want to connect with me just to see those highlights in case in case you missed a show, in case you want to just catch up on the important things. And we take the most valuable part of every show and turn that into a quick snippet, a highlight that's maybe, you know, 35 seconds to a minute and a half. And we just give you it's 100% value. And it's usually something that people say to me, I didn't know that, or I'm glad I watched that. So I hope you'll connect with me on social media if we're not already connected, maybe just watching on YouTube or something, right? So anyway, we've got a couple things to talk about today. June, we start off with the usual suspects: war, oil, inflation. Today is also the first day that the Fed has started to wind down instead of wind up its balance sheet, letting securities roll off. And a bunch of funky things and worries. Look, just because we went from June to May doesn't mean the worries went away. It's the same worries. I also know that people are checking their brokerage accounts today, the value of their accounts. You're logging in, you're checking, you're saying to yourself, holy cow, I can't believe what happened in May. So I want to make sure you don't jump off a cliff, and we talk about that as well. And again, if you have any questions, ask me in the comments. And I want to talk to you about something called I bonds. Have you ever heard of I bonds? I think you should hear about them. And I think they would be, I think for the right person, they could become a pretty conservative, important part of an investment portfolio. Let's put it that way. So we're going to roll the intro. We're going to talk about these things, give you a quick update in the market, but also bring you the perspective because I don't want anybody, flipping out, selling into a down market, or doing something today that might feel good, but could have like seriously bad ramifications on you 10, 15, 20 years from now. Right? How many people wish they could go back in time and buy stocks in a really bad market and they'd say, I'd have so much money today? Well, today may be that really bad time. So you definitely don't want to be a seller to the person who's the buyer at this point, in my opinion. But we'll have to talk about it and see if it's right for you. So let's roll the intro. It's going to be a good show. Here we go. All right, thanks so much for joining us. I'm Mitch Goldberg. If you're just tuning in now, we are just getting started. This is Be the Boss of Your Money. I call it Be the Boss of Your Money because the idea is to give you the knowledge, to share with you knowledge, the benefit of over 30 years of being a financial advisor. I just want to share with you so that you could take control of your finances, so you could potentially make better decisions for yourself and for your family. That's what the show is about. It's not about selling or pushing anything, really. If you watch the show and you know me, then you definitely know that. So what we're going to do is we're going to take a look at the market. We had the nice rally last week and things are giving it back a little bit yesterday, first day after the Memorial Day weekend. Obviously, it's yesterday, and today a little bit of the same. but nothing drastic. It looked like stocks would be down a lot today. And then toward the middle of the day, stocks bounced back nicely off their lows to the point where it was just a modest down day, nothing to write home about, no major signs in the market. But there is one dude who is giving us a big warning, and his name is Jamie Dimon. If you don't know who he is the CEO and chairman of JP Morgan, the biggest bank in the world. And he says a storm in the economy is coming. Well, who would argue with the CEO of the biggest bank in the world? And he seems like a very involved manager. I mean, he's very well respected and very well, admired and liked. Uh, I've been saying this for a while. I've even said this on TV that I do think we're in a recession now. I think it's already begun, and just because things are looking okay, uh, that's what fools people. If you recall the recession that hit in 2000, everything was great right up to that point. 2007, 2008, we had that financial collapse, but right up to the minute, right up to the start of it, things were looking pretty good in the economy, nothing terrible. So it just when the economy rolls over into a recession, it happens pretty quickly. The signs are there. And I'll tell you the signs that I'm looking for in a moment. First, let's take it to the boards and let's take a look at what happened today in the market. Okay. So the Dow is down about 177 points. No big deal. Nasdaq off about 86. Not the biggest deal. To me, under 1% moves are so tame today that it's like hard to even I don't get riled up by them at all. S&P down 31 points. Gold barely up. Oil up a drop. The 10-year yield going back up. That's getting closer to 3%. And I wonder at 3% if people start to sell and panic a little bit. And the VIX is down. The VIX down to 25.69. So, we're getting close to 20. If we see the VIX at 20, I'm telling you, under 20, we've got ourselves a nice rally in our hands. So we can't get overly negative. And, last week, part of the story was the week before last week, actually, I was saying, don't get too negative. We have a lot of good things to look at also. It's not all doom and gloom. It's not all, bad things happening in the market and the economy. And sure enough, we had this big rally. I think the Dow was up like 6.5% last week. That's a pretty good move. Still down for the year, but it definitely helps things recover. And there's no assurance that we do go into a recession. It might feel like a recession for a lot of people, but it's not a guarantee. Well, there's nothing that's guaranteed, right? We might not go into a recession, and if we do go into a recession, it might not get that much worse for stocks because stocks don't necessarily have to tank during a recession, and stocks don't necessarily have to go up in an economic expansion. Stocks do what they're going to do. And I know we like to think we have control over everything, but the stock market is definitely something you don't have control over. I mean, you have more control over the stock market, I guess, than the weather, but you don't have a lot of control over the stock market. Okay. So one thing. So we went over that. Let's take a look at the Treasury market, the all important Treasury market. Short term yields were all up across the board. Okay, the 1 month is now 0.768. I think it's the highest I've seen it since the Fed started tightening rates. The 10-year is very close to 3%. It's a little bit under the 7-year, so we have a slightly, and the 5-year is a little bit above it. We have a pretty flat yield curve, I would say, right now. Pretty flat, and the longer end of it is actually a little inverted. That tells you a couple of things. It does tell you that the bond market is showing a lack of confidence in the economy. It shows you that, hey, maybe there is a recession coming on. And it also tells you that maybe the Fed's policies are already starting to work. I do see pockets of weakness everywhere. And, like People keep talking about how strong the consumer is. I was talking to my friend Lenny the other day, and yeah, we always talk about the economy, and he's a business owner, so he's in a international business, and we always talk about the economy. And I said, people keep saying the consumer is in such good shape, and I'm saying no, the consumer is not in that good of a shape. They may have been in good shape, but I don't think economists are giving enough weight to how badly the consumer is doing because of inflation. It's that bad. It's a really horrible situation for consumers. And people say, oh, their balance sheets are strong, they're flush with cash. Well, there's a record amount of new credit card accounts being opened. Job openings, while still plentiful, the number has decreased a lot because job openings can disappear very quickly. And a lot of companies have put on hiring freezes. After hiring freezes, what comes next? Layoffs. I don't think the consumer is in that strong of a position, and I don't know why economists keep using that as a reason to be bullish. And that doesn't even have that much to do with the stock market. Actually, some of the economic stats today they were pretty good. Like ISM manufacturing was pretty good, better than expected, and the market went down on that because people felt that the Federal Reserve has to stay aggressive in pulling back stimulus and raising rates. Maybe we get a weak a weak economy, weaker and a real recession, and the Fed says we have to ease, we have to stop tightening, and all of a sudden the stock market flies up again. So there's so many things going on, and for people to sit here and act like they have some kind of control or they know what's going on, it's just nonsense to me. All right. Um, so let me show you just aftermarket. GameStop came out with earnings. The numbers weren't so great, but the stock is up ever so slight in aftermarket trading, up 9 cents, 344 down to 121 from the high to where it is now. I'm sorry, I don't mean to be rude. I'm just flat out. By the time I get to like 5 o'clock, I'm like my eyes are foggy. I work a long day. I work a hard day. I like what I do. I like what I do. Don't get me wrong. Okay, don't get me wrong. Jamie Dimon. Here it is. Jamie Dimon says, brace yourself for an economic hurricane caused by the Fed and Ukraine war. What do you guys think? You think it's that bad out there? By the way, just two quick shout outs. Jerry, Michael, thanks both of you. Thanks to both of you for joining me. What do you guys think? You think it's that bad out there? Do you think do you agree with my assessment? Again, I could be wrong, so I have to couch that. Is that the right way to put it? Couch that, right? Maybe we go into recession, maybe we don't, but it looks like we're headed there. And let's take a look also the 30-year fixed rate. 30-year fixed rate up to 5.47%, so right at its high. So mortgage rates had a reprieve for like 2 weeks, barely. I mean, they went from like 3 to 5, almost 5.5 to like 5.3 and back to 5.5. It wasn't really that much of a reprieve, but housing has slowed down a lot. I have a friend who I'm giving you some anecdotal evidence. I have a good friend who is he's a successful mortgage banker or broker, whatever you want to call him, mortgage banker with Bank of America. And this is not somebody that got into the mortgage market when it was hot. This is a guy who's about 60 and who's been in the mortgage industry for 30, 38 years, his whole entire adult life. Not just someone who's a Johnny come lately and got into it because it's a hot business. And if you have a good rap and you can talk to people, you can close some mortgages. No, not that kind of guy. This is a true, tried and true professional. And he said, everything is dead. Forget the refi market. That's completely dead. And he said, houses aren't selling. People aren't buying. We haven't seen the turnover yet in the price of houses. But I think, and he thinks that that's next, because if people aren't buying, then a seller has to lower their price to stimulate demand for the house. And I think it's like that everywhere. Everything I've been reading about housing and mortgage rates seems to confirm that. Okay, so let's see what the sectors of the day were. Most sectors, I think, 10 out of 11 were down. I'm going to go by the sector ETF. Yeah. So the sector ETFs, by the way, are the ETFs that track the 11 sectors of the economy. So XLA is energy. So, of course, that was up. Energy had a decent day. Chatter about time to sell energy stocks, time to short them, time to scale back, time to avoid. I think all of the above. Um, I have some gains in these stocks. I have to take some of it. I have to take some off the table. I would be remiss not to do that for my clients. I would be remiss. Okay, and I don't want to be remiss. XLE up $1.42. Everything else is down. Utilities, technology, industrials, building materials. What's at the bottom? Financials. Um, Wells Fargo's bank analyst, Michael Mayo, who's a very well known, very highly regarded analyst, came out and made Bank of America his top pick. BAC is the Bank of America ticker symbol. All right. And what else we got going on? I want to talk to you about something called I-bonds. Have you ever heard of I-bond? I was talking to a friend of mine. I'm not going to say the full name just because maybe she doesn't want me to say her full name, but I'm just going to call her Kay. You know who I'm talking about, Kay. Okay. You're like, oh, that was me. We had the conversation. And I know about I-bonds. It's just the thing about I-bonds, it's not something that's generally available through a financial advisor like myself. And I think that's why I-bonds don't really get enough, enough respect. But they're a really good tool. I-bonds pay a fixed rate on a bond plus inflation. So let's say the fixed rate is about 1% and the add inflation. So I-bonds are now paying about 9.67% interest, which is really as good as you're going to get, and they don't lose principal. Even when you go to sell your I-bond, they're always flat. You always get your money out plus the interest. And the way they work is they compound every 6 months. So every 6 months, the rate is recalculated based on inflation. And it's that rate is added to the interest. At the end of 6 months, you keep the interest that you've gotten. It gets added to the principal, and then you get the new rate that's the newly calculated rate for the next 6 months on your original investment plus the principal, which means it's compounding. And unlike regular bonds, which don't compound, you always have to fight or figure out a way to reinvest. I'm talking individual bonds. With I-bonds, they reinvest, they compound, and if interest rates go up, the yield goes up. The variable rate, which is the inflation rate, that part of the I-bond yield will go up, but the principal stays the same. So if you buy one of these, let's say 5 years later, you need to sell the bond, you don't lose any principal. You may lose up to the last 3 months of interest. These are meant to be long-term holds. I think if you sold over the short term, you could lose 3 months of interest, not over the long term. I'll have to double check on that, but that's not really what's important. Okay, you buy them on this website. It's called Treasury Direct. Let me move my face over here so you could see it. Let me make this a little bit bigger. All right, that's a little bit easier to see. Buying Series I bonds, the initial rate, the initial interest rate on new Series I savings bonds is 9.62%. You can buy them through at that rate and keep that rate for 6 months through October of 22. Okay. I bonds can be purchased through October 22 at the current rate. The rate is applied to the 6 months after the purchase is made. All right. So if your purchase is made, for example, if you buy an I bond on July 1st, the 9.62 would be applied through December 31st. And interest is compounded semi-annually, which is a good thing. The interest is actually just added back to the value of the bond. So if you buy $1,000 I bond and you get $96.26 and $9.62, okay, then the bond is now worth $1,009.62, and you earn your interest on that amount. So that's why it compounds. Okay, but if you go to treasurydirect.gov, All right. You'll have all kinds of FAQs, and it'll show you how to buy them. There are some limits. Okay. When you buy an I bond, a lot of people think the most you could buy in these are $5,000 or $10,000, but there is a way to buy $15,000 worth. So typically speaking, if you use cash to buy an I bond, you can purchase up to $10,000 of an I bond in your account and earn 9.62% on that amount. If you're married, your spouse can do the same thing for $20,000. If you have children who are minors, you could buy for them too. So if you have 3 kids and 2 parents, that's $50,000, earning 9.62% in an I bond. That is pretty darn good, and it's adding up. You could also buy I bonds for other people, children and adults, and give them I bonds, and they could get the same benefit too. So if you have children who are no longer minors, they're majors. Just kidding. Minors, majors. That was really funny. If I was like a music teacher, I would think that was really funny. I would say that would be a sharp note. You get it? Sharp. Or did that joke just fall flat on its face? If you're a music guy, you know what I'm talking about. Okay. What the F was I talking about? Oh yeah, I bonds. So you could buy the I bonds for your whole family, earn a great yield. They are free from state and local taxes. They are subject to federal taxes like other government bonds. Okay. And unlike TIPS, Treasury Inflation Protected Securities, whose principal is adjusted up or down, but the yield stays, the rate stays the same. I bonds, the bonds stay the same price, the principal stays the same, but the yields go up or down depending on inflation. The risk is that if we go into a deflationary period, then you wouldn't get anything. You're not going to actually owe money, though. You're just not going to get paid anything. Um, that's really it. I think this is a pretty cool way to put away some money and save. Um, let's see. We have some comments here from Slim Dog. I love that. Slim Dog. Yeah, baby. Pound it. Okay. I bonds are a great way to save for midterm goals right now. Indeed. You and your spouse should load up 10,000 each and more if you buy for a trust. Okay. There you go. That is true, by the way, if you buy for a trust. But I also want you to know that if you buy $10,000 of I bonds and you're getting money in a tax refund, let's say you're getting $5,000 in a tax refund, you could use $5,000 or up to $5,000 of a tax refund, and instead of taking a tax refund, you could get another $5,000 worth of I bonds. So conceivably, you could purchase up to $15,000 as an individual of I bonds. And I think it's a pretty cool thing. This isn't for everybody, so that's why I highly recommend that you go to treasury treasurydirect.gov, check out the FAQs, key facts. They compare them to triple E bonds, I'm sorry, double E bonds, excuse me, and E bonds, and they triple. I'm thinking of a shoe size, right? Uh, but you could do that, and they compare them to TIPS, Treasury Inflation Protected Securities. This isn't for everyone, but you should read about it, see if it's for you, and if it is, then you can certainly feel free to go directly to Treasury Direct and buy your I bonds. And if you're my client, and you do this, just let me know that you did it, just so I know you took care of it, and I'll be very happy for you. And if you didn't want to do it or it's not for you, that's okay also. Although the more I look at these, the harder it is for me to figure out why somebody doesn't do it. And I know if you have a big net worth, like a multi-million dollar net worth, you're thinking, what the hell's $20,000 going to do for me? Well, this isn't a bad thing to put away for your children or grandchildren either. And again, you do this all on your own, direct. It's all in electronic form, and I think it's a very good option to look at for the safer portion or the more stable portion of your portfolio. And by the way, when I talk about the S&P 500 or Dow Jones or Nasdaq, I just have to say this, that you cannot invest directly into an index, but you could invest into a security that tracks or mimics an index. And I think that's all we have for today. So I thank you for watching. Tomorrow is Thursday already. We love a 4-day week. And I'll be back Yeah, I'll definitely be back tomorrow. We'll be doing a show. We'll be doing our thing. We'll be getting it on like Donkey Kong. Yeah, I just said that. And Natalie's probably, you're just rolling your eyes right now like this. What can I tell you? A little wacky. All right. That's it. I'm going to end the broadcast. See you tomorrow. Bye.